Canada's annual inflation rate fell to 2.3% in January, primarily driven by lower gasoline prices. Our next guest expects inflation to remain subdued, but anticipates that the Bank of Canada will remain on the sidelines for the time being. So let's welcome in Benjamin Tal, Deputy Chief Economist at CIBC. It's good to have you join us. Thanks so much.
A pleasure. Thank you.
So let's dig into that first point a little more. Inflation getting closer to that 2% target. You don't think that's going to move the needle at all with the Bank of Canada?
No, I think that, listen, inflation is not an issue when it comes to Canada at this point. In the US, it's different. It's still elevated. In Canada, we are okay. The Bank of Canada, in my opinion, has the green light to cut if needed. They will not, because they're telling us that they will not cut interest rates. But when people talk about interest rates in Canada rising in 2026, I don't believe it. I think that if there is a risk when it comes to interest rates in Canada, is that they actually will go down, not up, in 2026. But at this point, our call is that the Bank of Canada will do nothing until 2027, reflecting a weaker economy, clearly a relatively elevated unemployment rate, and inflation that is not an issue whatsoever.
Okay, so let's dig into the numbers a little bit more, because I'm wondering if there are any other categories here that actually contributed to the drop in inflation that we saw. It was a very slight drop.
Yes, we are talking about food prices. Food prices actually went up. Why? Because we got this GST, HST break last year. That will continue to be the case. Despite that, if you look at the 3-month moving average annual rate inflation, in core inflation, it's about 1.5%. So the more recent numbers, if you exclude food that is as a base effect, it's really going nowhere. So clearly, inflation is not a factor. Another factor which we have to look at is rent. Rent is a very important part of the CPI. And we know that the asking rent is actually going down in the country, especially in places like BC and Ontario. At the same time, on a year-over-year basis, the rent inflation, according to the CPI, is about 4.2%. I don't buy it. I think the number is much lower than that. So inflation might actually be lower than perceived.
So, okay, you don't buy it. I mean, shelter prices dropping. Do you think that's enough to stimulate kind of renewed demand in that sector?
Not yet, not yet. It will take at least a year or two. If you look at the condo market, for example, prices will continue to go down for the next year or two before they stabilize. Rent inflation will continue to weaken, and I think that they are not actually negative yet. They will be negative in the next few months when it comes to the average. So overall, it's not enough to solve our affordability issue, if you wish, but it clearly a step in the right direction.
Okay, so let's talk a little bit more about gas prices, oil prices as well, because excluding gas, January's inflation rate was actually 3%. I'm wondering if you think the current oil surplus is creating a false impression that inflation is under control at this point.
Well, that's why we look at the core inflation as opposed to the total CPI, because it's dancing to the tune of oil prices that change all the time. Therefore, the Bank of Canada cares more about, if you look at inflation minus energy and food and all kinds of other items. And if you look at core inflation, what the bank is focusing on average in the last 3 months was 1.5%. That's why I think the Bank of Canada, if needed, has the green light to cut.
Okay, let's go back to food as well. You mentioned food prices off the top, obviously a big contributor to the numbers we're seeing today. Do you think we're going to continue to see food prices where they are, grocery prices? What needs to change, I guess, for Canadians to see lower prices at the grocery store, something a lot of people are always talking about?
Well, mathematically, it actually will go up over the next few months, because if you remember, we got the GST, HST break last year on food. So you go down and then you go up. So the spread is higher. Therefore, it's called the base effect. And this we will continue to see over the next few months. So don't pay attention to food prices rising. The level is relatively high, and that's a totally different story. And quite frankly, unfortunately, I don't see the level of prices going down, so you will have to continue to mortgage your house to buy a banana or something.
Okay, so you don't see anything there, any relief there. You see an expectation of continued moderate inflation. I mean, is this a time for Canadians to be panicking, do you think?
Nothing to panic about. The most important factor at this point is not inflation, is not even interest rates, is actually Trump. And I'm very optimistic about the situation with Trump. I believe the time is not on his side. We have a situation in which in November he's going to face the voters in the midterm elections. Time is not on his side. He will have to compromise. They are already talking about renegotiation of USMCA. And I do believe that the tariffs are here to stay, but they will be relatively low. I don't see tariff averaging more than 10% on Canada, which is totally manageable when it comes to the overall impact on the economy.
Okay, so that's optimistic. Just very quickly here, because we do have a little bit of time left, I wanted you to comment on the last quarter's jobs reports. It was negative. Did that impact anything that we're seeing today?
Not really, not really. Clearly, the economy is not strong. If you look at the overall GDP growth in the fourth quarter, it will be negative. The unemployment rate is elevated, especially among young people. And clearly, we have the labor market not moving in the right direction. Again, if people were talking about the Bank of Canada raising interest rates in 2026, I think they are absolutely wrong about that. The Bank of Canada will not touch interest rates, reflecting the weakness in the labor market. Youth unemployment is a very important issue, something that we have to focus on. And clearly, we need to keep interest rates low to provide some sort of energy to this economy, including, by the way, the housing market that is in a recession.
Absolutely. Okay, that's all the time we have. Benjamin Tile, Deputy Chief Economist at CIBC. Appreciate you joining us today. Thank you.